All right, let's dive into a real economic head-scratcher using a fantastic example from Gaurav Agrawal's Indian economy. We're going to explore something that seems completely backward. How can amazing news for workers, tons of new jobs, be absolutely terrible news for the stock market? Let's unpack this. So picture this. It's late 2022. The US gets a jobs report that's just off the charts good. I mean, unemployment is at a historic low. You'd think Wall Street would be celebrating, right? But nope. Instead, the market completely tanks. It just doesn't seem to make any sense. So what was really going on here? And we're not talking about a little dip here. The Dow plunged by hundreds of points, and the Nasdaq lost almost 4%. Clearly, this good news on the jobs front seriously spooked investors. To figure out why, we need to find our very first clue. Okay, so to solve this whole puzzle, you have to understand the bigger picture at the time. You just can't make sense of the market's reaction without knowing about the one number that was on every single economist's mind. And that number was inflation. It was running hot, over 8% in the US. Now, to put that in perspective, that was a nearly 40-year high. This made inflation the #1 economic enemy. Everything else, literally everything, was secondary to getting that number back under control. So how do we connect that crazy high inflation with those really low unemployment numbers? Well, for that, we need to pull out a classic tool from the economist's toolkit, something called the Phillips curve. In the simplest terms, the Phillips curve basically shows that there's this trade-off. As unemployment goes down and more people get jobs, inflation tends to go up. And on the flip side, when unemployment goes up, inflation usually starts to cool off. And the logic behind it is pretty straightforward. Think of it as a tale of two economies. When unemployment is low, lots of people have paychecks, right? So they're out spending money. All that extra demand for goods and services pushes prices up. That's inflation. But when unemployment is high, people have less money to spend, demand cools off, and inflation tends to come down. Okay, so we've got super high inflation and a really strong job market that, according to our theory, is only going to pour more fuel on that fire. This puts the central bank in a really, really tough spot. It creates a serious dilemma for them. The market, it connected these dots in a split second. They saw the strong jobs report and thought, okay, according to the Phillips curve, that means more inflation is coming. And that means the central bank, the Federal Reserve in the US, is pretty much forced to use its main weapon to fight inflation. And that weapon is, you guessed it, raising interest rates. And that brings us to the final piece of this puzzle, the big reveal. Why on earth is the idea of higher interest rates so terrifying for the stock market? Well, the answer has everything to do with what was pumping up the market in the first place. See, coming out of the pandemic, the central bank had what's called an easy money policy to keep the economy going. What does that mean? It means they basically flooded the entire financial system with cash by, printing money and keeping interest rates near zero. And just look at the scale of this thing. The Fed's balance sheet more than doubled, jumping from $4 trillion to a staggering $9 trillion in a really short period. And a huge chunk of all that brand new money flowed directly into the stock market, pushing prices up to record highs. So here is the absolute crucial point. The market wasn't actually reacting to the good news about jobs. No, it was reacting to the predictable consequence of that good news. Everyone knew that a strong economy meant the Fed would have to raise interest rates, which would effectively turn off the tap of cheap money that had been propping up the market for years. So let's just walk through that whole chain of logic one last time. A strong jobs report sparks fears of higher inflation. That in turn creates the expectation that the central bank will hike interest rates. And that rate hike signals the end of the easy money party, which causes the stock market to fall. It's a perfect illustration of how good news for Main Street can sometimes feel like really bad news for Wall Street. This quote just perfectly captures the difficult tightrope that policymakers have to walk. And this isn't just a US problem. It's a fundamental challenge for any central bank, including India's RBI. Getting a handle on this balancing act is absolutely critical to understanding modern economics. And honestly, it's this kind of clear, step-by-step breakdown of these core concepts that makes Gaurav Agrawal's Indian Economy such a valuable book. So the next time you see the market make a big move, ask yourself, is it reacting to the news or to the reaction to the news? Thanks for watching.